All right, so after yesterday's kind of really good breakout move, we were looking for some follow through today, and we got it to a degree. It wasn't the best, but it's also the last week in August before Labor Day weekend, and it's probably the best we can get considering the environment. Now, that doesn't mean that we're not due for some potentially market moving news over the next couple of days, so stay tuned for that and see. We'll talk about that, of course, of how it impacts the markets, but we might not be getting the follow through until at least next week. The problem, though, is we had a pretty decent move over the past so many days. I'm going to show you that. What is the expectation now after this kind of a move? Are we going to start an intermediate rally? There's a lot of signals that suggest we are starting an intermediate rally. Our trade idea of the day is a way that we can take advantage of the beginning of a new intermediate rally with the S&P 500, kind of using a proxy for it on an individual trade, just on one individual trade. So that's, so we're going to talk, I'm going to show you all those signals. But there are some red flags. There are some red flags from an intermarket relationship. It's one in particular that's not doing. A lot of people are talking about a couple of these different asset classes that are showing some weakness that prompts a lot of this risk appetite. But there's one that's kind of associated with them that is not. And I'm going to show you that with some of the other red flags as well that suggest maybe we might have more over the next so many days, a little bit more of a negative move than what we anticipate, what a lot of people anticipate because of how bullish we've been. So let's go ahead and get started. Today is Wednesday, August the 30th, 2023. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, before we get going too far, I invite you to subscribe to our YouTube channel with this icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos. And join our Market Outlook Facebook group that we've created. All right, if you're watching us here on our blog, check out some of these other things over here on the right, including our Market Outlook live video. Come down to the bottom, click on this heart. It opens up this tab. Hit that like button there. Same thing here. Click on this thumbs up icon. It opens up this tab. Hit that like button. Again, that helps us out tremendously. Get our content out to all of our followers on those platforms. The more engagement these posts have. That's why we always ask for it every day. Our 100's our goal, so we're getting a lot closer to that goal there. So thank you to those of you who like us day in and day out on these. For those who don't, you can do it right now while you're watching with one or two really easy clicks. All right, let's take a look at the S&P 500 with the market forecast indicator like we always do. We'll start off taking a look here at this bear tag. Again, bear tag, remember, is a close. The combine, it's actually the light green shading and the yellow line. That's what makes it a bear tag. The light green shading comes from the intermediate line rising above the 20th percentile, but not above the 50th yet. When it gets above the 50th, it turns dark green. And then again, the yellow line means that we have closed above either above a falling moving average or below a rising moving average. In that case, it would be a bull tag, and this would be a bear tag. So that's the idea behind that. Again, bear tags start these intermediate runs, right? They start these intermediate runs. Or they can also be a bounce to the downside, like this one here, like where we got a bounce back down to the downside and continued the intermediate route decline that we were on initially. So you can see more often than not, they start these intermediate rallies. This is the only one that ended up being the bounce down to the downside. So the odds are this is starting a new rally. How will we know that it's not? Well, one sign you can see, we did get over here on this one, we did get the near-term line and the momentum line both up there. The intermediate line never did get back into bullish territory there, and we never did get very far above the moving average. In fact, we never did get above the 2.5% mark above these. So that is one sign. When you get the bear tag and you don't follow through with some more bullishness to the point where you kind of come back down, go back up, come back down. That's one sign. We got a little bit of a sustained move to the upside. It was very small in range, very small volume, as you see here later in a minute. Regardless, the near-term line did rally to extreme levels, to bullish levels, so that's a positive sign, right, to get up to that point. That is one, but we're still only less than a percent above the moving average. So we're not out of the woods yet. As you know, we could easily get back below the moving average, which would turn it back to red if we did. Well, if it's still falling, we can get back below the moving average really easily. So the idea is you want to like these bull tags ended up being bounces instead of beginning bearish declines. I mean, we bounced back up initially. We reversed initially. We didn't continue to go down like we did when these bull tags started the intermediate decline. So we want to see this continue. Instead of bouncing back down, we wanted to see it continue to go back up. And today is a good start to that. It wasn't the best start because, again, very small range. And we're still, like I said, even less than 0.75% up above the moving average. But it is a start nonetheless. So that's good. 4 days in a row. In fact, if you look at the 4 days in a row rally that we've had, so if I change, you remember how we haven't had a 2 days in a row to the upside on the S&P 500 all the entire month of August going into that expiration. In fact, we had a lot of down days in a row. Well, here's 4 days in a row, and not only do we finally have 4 days in a row, but look, a 3% gain plus gain, that's a pretty decent move. In fact, the last time we had this kind of a gain or higher was the last time we started a new intermediate rally to the upside. Now, remember, again, March, the VIX was a little bit higher than it is now. It was barely above 100%, but regardless, that's the kind of move we had. It was a 3.85% gain over 4 days versus 3.16. But again, that's you can see, on the other hand, as you get closer to 3 days, that can also signal the end of a run. We haven't had that much of a run, so I don't think necessarily we're signaling the end of a run. Over here, you can see we also had a 4.25% rally in 4 days that started that intermediate rally to the upside, and tons of those strong levels over here. So needless to say, we've gone up pretty well, and you can see once we peak, we can either drop pretty sharply. Right, so either we're going to drop pretty sharply, these are going to fail, or we're going to kind of grind down as this intermediate rally begins, right? So even this one, we dropped sharply and just kind of went sideways for a while. Over there. A lot of these we dropped down as soon as we got up. So really important that we do this, right, where we kind of grind down instead of dropping straight down. With a negative, I mean, we're going to get a 4 day decline over here. You can see every time you get a 4 day rally, you're going to get a 4 day decline. Even when we're bullish, you get a 4 day decline that comes after that. So that's not going to be, horrible here. The problem would be if the next 4 days are all, is a negative decline, and we come back down into this area, 4,400 or lower. That's what we do not want to see. So really important how we finish the week, going into a holiday weekend, which will probably be like today, like nothing burger of range. It's really even more important how we come out of Labor Day. Once the volume kicks back in, people are back to work, back in school, we're back to kind of normal here after Labor Day. That's the week that matters the most, and that's again traditionally not the most bullish time of year. And so we're heading into a traditionally not bullish time of year, set up for a not that kind of bullish kind of move over the next 4 days. Let's take a look. So that would be Friday, Tuesday, Wednesday, and Thursday of next week, right? So that's employment tomorrow. There's a lot of PCE. So it'd be Thursday, Friday, and then Tuesday, Wednesday of next week. So PCE tomorrow, employment on Friday, and then a new week as we head into a new CPI release. Not next week, but the week after that, which is expected to be a pretty strong one, a pretty strong month-over-month figure. Let's take a look at the NASDAQ 100. That's been driving a lot of this action here. It is up more than 1% or 1.5%. It's a little different, a higher beta, so it's going to be bigger numbers here. It is coming off of a cluster pre-expiration, and we got the bear tag yesterday and followed through. Again, strong. I mean, almost exactly the same. The intermediate line's coming out of bearish territory there. The Russell 2000, the intermediate line came out of the lower reversal zone, so that's a good sign, but still not the bearish tag because we're still 1% below the moving average. So again, not out of the woods there. And then your Dow Jones Industrial Average, you can see also not above, not getting the bear tag, not above the moving average. The intermediate line is not out of bearish territory either. A little bit higher than the Russell. And you can see market sentiment's falling. It's rising on the Dow, but pretty much has been in this downtrend for quite a while. So So, again, the pattern is there for a bounce because we get more of those than we don't. But there's also some really red flags about the likelihood that this will be a bounce like all the rest, and instead could be one of those bear tags that instead of leading to a trend change, an intermediate trend change, it leads instead to a bounce back down. So again, next 4 days, really important that they don't end up being as negative, because you remember, going back to that rate of change, they don't, that rate of change doesn't turn negative over 4 days, but it gets down to pretty decently low levels as well, right? It gets down to about 1% or 2%. After those 4-day rallies, you typically have about 1% or 2% decline or more after some of these other peaks. So that's, again, we want to see this kind of move where we just kind of grind higher with a negative 4-day rate of change and not a 1% decline over 4 days. That brings us, like I said, back, threatening to get back below that 4,400 level. Again, 1% would be only about a 45-point change or decline. So that's not that big of a drop. It wouldn't get us very far to the downside. In fact, it would kind of keep us in this area if that's all it ends up being. Anything more than that threatens to be more bearish than what we really want or feel comfortable with. Let's take a look at the weekly chart. A very bullish reversal sign here. Got the green arrow on the rising 10-week moving average now. And you have a bullish candle, Hakinyashi candle, reversal, like a pretty decently bullish. It's not the strongest, but it's pretty decently bullish Hakinyashi candle there. So that's a good development. And again, we're more than halfway. We're halfway through the week now, more than halfway through the week. So that's a good sign that we're still that bullish. And with what's expected to be, a couple bullish indicators due out of the next couple of days, that should rally the markets a little bit more. It should, if we follow the same pattern we have been over the last couple of days. We do have 3 green arrows across the board, except for the diamonds and the Russell 2000, right? They're still lacking that third green arrow on the moving average. They're still below their moving averages there. The S&P getting above the 50 and the 30 yesterday. Big move. Above the 17 barely the day before that. MACD is crossing 0, so that means the 8's crossing above the 17. They're still both below the 30, but they're moving pretty rapidly to the upside. Stochastics is flirting with getting into bullish territory. We are above the 78% retracement level again, right? So again, this line represents the fact that the correction is over with. You get above this, you stay above it. Don't just fiddle around, but you get above it and you stay above it. Then that means that we're more than likely going to get above the pre-correction peak, the 100% level. And that's when things really start getting going from there, right? So the first step is to get above the 78% line, and we've got that today. So after a good breakout yesterday, again, not the best follow through today, but pretty decent, right? It's a good start to some follow through that would be the beginning stages of a new intermediate trend. The DMI is also showing some good follow through here, below 20 in the positive, not by very much. You can see when you get just barely above or below these lines, you can reverse pretty quickly. So I'd like to get down there a little bit more than that, so we don't reverse really quickly. The positive at least is well above 25, so that's a good sign. Not quite above 30 yet, but at least it's above 25. And the ADX is not very low. We can turn right back up and get some good movement on the stock. The RSI and the CCI, we did get above 150. Got above 100, also got above 150 on the CCI. Getting above 100, of course, is the more important level. Getting above 150 suggests how strong it is. We're above 50, but we're not quite above 60 yet. So to confirm that move above 150, we need the RSI to also get above 60. Then that suggests that, okay, we can be done with this red box and start a green box, right? Start a green box here. But we got to get above 60 for that to happen, along with this bump above 150, and we just haven't done that yet. That may be a day or two away. Again, if we get the 4-day decline of 1% or more, then that won't happen, right? We'll fail, and then the question is, will we get back below 50 and then get back, potentially below 0? That of course will be the issue over this next week or two. Looking at the Ichimoku cloud, we are done with that bearish trend. We're back above the cloud. We're back above that blue line. Rate of change is still negative, but not by much. The trend is gone, so we've hit zero on both these trend quality indicators down here. So the negative trend that we had going on, which is what you get when you're in these intermediate declines, that only got to about intermediate trend strength, is gone. So again, another good sign that the intermediate trend is over with and we're bouncing back up to the upside. Finally, let's take a look at the Bollinger Bands and the Keltner channels. We are back into the upper quartile the past 2 days. It's not the best level. It's not in, if you'd like to get above 100 when you're starting these intermediate rallies. But at least get up and push up to that level. Get up a lot closer, get into the 90s, if not the 95th or higher. At least we're in 84, so at least we're in the upper quartile, but we're not. Let's get another good strong day and push up against this line that has now come inside the Keltner channel. So we've got the red dots. Usually you get this change in momentum through the red dots. So when the bands come back inside, then we get the change in momentum in the other direction. So again, that change in momentum would be to the opposite, upside. So another good signal, potential reversal there. Let's take a look at today's intraday move. Higher high, higher low, closing above yesterday's high. Good, all good there, right? We're not quite at a new 4-week high point. This is going to be the 4-week high point after today. Follow my cursor all the way over to the right, and you can see just how close we are. We're really, literally just a couple of bucks away. We were up a couple of bucks today, so we're just a couple of bucks away from getting a new 4-week high point. It doesn't have to close there, right? To get that high tag over here, we just need a high. We just need an intraday high there. So just a couple of bucks away, and then after a couple of days, it's actually going to come down here to 451.70. And if you look at today's high point was early today at 451.62, or excuse me, right here, 451.67 in the middle of the day. That's how close we are. So we are that close. If we get any kind of higher high tomorrow, then at the very least, if we don't get a new high tomorrow, we most likely will get it the next day when this comes off the table. So which means, again, because what we're looking for, the reason why we want a new high is we want this to spike up to 100. That means we got a new high today, and that generally starts these intermediate rallies, right? It generally starts that when you get that new high point. It starts these intermediate runs to the upside, especially with that negative indicator further along, right? We haven't had a new low for so long. It's moved further to the side. Again, good environment for a new bullish intermediate trend to begin. Looking at today, this is where kind of a little red flag is, and it's not surprising. Low volume, very small range. It's like the two worst days. I mean, a lot of people are gone today, tomorrow, starting tomorrow, especially heading into the Friday heading into the weekend. We do have some important things out the next couple of days, so we might avoid this kind of volume day like we had on August the 14th. So we might be able to avoid that, but that's the kind of move we typically get. So I wouldn't feel too happy about a good strong rally on very light volume. But it also might mean that we might not get the follow through that we're looking for before the weekend hits. So it might need to occur after we digest the news and then after the holiday goes through. Then when we get more volume back to average and back to a regular range, then we might get that move that sustains the change, sustains these reversal signals, and then again, however long. Because once you get a new intermediate run started, the number that you end up getting in this green tag could be 10+%. 14% there, 10%, but those are our last two intermediate rallies, 17% over there. So, technically we won't get a new green tag because we didn't get a red tag. We didn't even get a 5% drop. So this green tag is just going to continue higher, but if we get a 10% move off of this close where it was at, then we're looking at 4,800 on this next intermediate rally. That's a good sign. I don't think we'll hit that because I don't think we had enough of a pullback, right, to where we can readjust the sentiment we need to get this 19 number up to 29 or up to 30, which is what it would end up being by the time we got there. So I don't know if we've had enough of a change where we really washed out, the extremes that we saw going into going into August. It was a good drop, but it wasn't the type of drop, especially when you look at the volatility here. It wasn't the type of drop that screams, oh, this sentiment really corrected, right? I mean, we didn't even get above, like I said, the 94th percentile there. The VIX didn't even get above 20. The VIX did not get above its 200-day moving average. And you can see now the VVIX is down below 80, which is extremely low and sets you up, especially with the change. I mean, if you look at this change in the VVIX, and this is the case over the last 9 days. So let me go back and change this. You can see the drop in the volatility of the VIX, right? When you take a look at that drop, that's a 26% decline. That's one of your bigger declines. And it really wasn't that high to begin with. Like this one came off of a 63% rally to the upside over 9 days, and we dropped 31% after that. Here, we just barely rallied 14%. And then at that peak, we were only up 11%, just barely over 10. And now we're down 26. So a big change in the VVIX off of what wasn't that big of a level usually suggests that we might end up having an increase in the VVIX and the VIX to come, right, when we've had that big of a drop off of what really wasn't that big of a rally to begin with. All right, now let's take a look at what's driving a lot of this price action. So let's come over here to our asset class comparison chart. Again, you can see the renewed strength in the Qs to go along with the strength we've seen in commodities. U.S. equities really killing it over the past few months relative to international equities there. Let's just look at today. So let's come down to August the 30th and look at today's moves. You can see the Qs, I mean, U.S. equities, again, just killing it. And that's even with a drop in the dollar. So emerging markets declined pretty strongly. Developed markets underperformed and were negative. That's something you would expect to see with the dollar up. But with the dollar down as much as it was today, that's not what you typically see. Long-term treasuries were actually down today. So that was kind of an interesting pattern. It's been, they've been rallying along with equities for the most part in this inflationary environment. And then now you can see they were actually down today. Commodities were up. So not necessarily the kind of pattern that would lead us to have such a strong, I mean, it wasn't that big of a move. At 0.5% is not that big of a range. 1/3% decline is not that big of a move either. So it looks like we're a lot more volatile than we really were. It's a very small range. Treasuries and bonds kind of matched each other, or corporate bonds and treasuries kind of matched each other. But that dollar move is kind of the more telling move when you look at the DXY here, DXY. You can see we did drop down easily below the 17-day moving average and slightly below the 200-day moving average, still above the 30, which is crossed above the 50. The MACD is down below its moving average. So again, we just barely got above the 200. Which is kind of a bullish sign for the dollar, and we'll see if this ends up being a failure or not here. If we can continue to move lower on the dollar, then that would set the equities up for a better that intermediate run. If this ends up being just a jump back up, a move to jump back up, then that's not necessarily what we want to see. The yields can continue lower. The 10-year yield, remember TLT is 20 to 30 year. The 10-year yield dropped to 4.12% essentially. That's right there at its moving average. It's rising pretty strongly. MACD and stochastics are down, but not into bearish levels yet on either one of them. So support holds and we bounce. We have a different narrative. Are we going to get a 4-day rate of change to the downside? That will only occur if the 10-year yield bounces here, and then the dollar bounces as well and doesn't necessarily break below that 200-day moving average. Commodities might be giving us a sense of that. Commodities are actually up today despite coming down from their highs. MACD and stochastics are positive. So it's going to be harder for the yields and the dollar to not go up if commodities are still going up, right? Those three have been kind of tied to the hip here lately in terms of how they've been impacting risk appetite. And so, like I said, it's a great little move on the dollar. It's a great little move on yields, but it's not being matched by a decline in commodities. And so if commodities continue to be strong, continue to move higher, especially in this case of this ETF, crude oil, which makes up a bulk of that, and crude oil is up today. If crude oil continues to push higher, MACD and stochastics turning up from bearish levels, bouncing off this moving average. 50 days cross above the 200, so we're in golden cross. So we haven't been in the golden cross environment on this on crude oil for quite a while. It's been since over here in the end of 2022 when we went to a death cross on crude oil, broke the 200 and the 50 cross below. And then the last time we had a golden cross established itself was back over here. Actually, it was a little bit further over. Where is it? It'd be over here in this range. We got above it, but the crude oil did come down, spend some time below the 50, but not enough to bring the 50 below the 200. We got right back above it, and again, the 50 stayed in the golden cross environment for a long time. You can see it better visually right here. Let me bring up crude oil in this chart. See, the shading tells you whether you're in a death cross environment or a golden cross environment. So you can see we were in a golden cross environment for so long, death cross now, or death cross here this year, and then now you can see we're crossing back up above. So are we going to stay above that level? That's really important to keep an eye on, to see, because if we do bounce off of this and get above 82 and we continue MACD and stochastics and everything goes up, and we go back up to pre-pullback highs and beyond, so above 85 essentially, again, it's going to be very hard for yields not to go up too, and it's going to be very hard for the dollar not to go up too, considering that they've been tied together. They've been as correlated as they've been in terms of either providing risk appetite or driving people to risk aversion in 2022, and those three, that three-headed monster of last year. Let's take a look at how the sectors performed today. So we'll come down to the comparison chart here. You can see how energy has been bouncing up with that rise in crude oil. So it's had some pretty decent returns over the past 3 months relative to its peers. Discretionary has been outpacing the other cyclical areas, communication services and technology. Let's come down here to the 5-minute chart. Technology had its day today. So NVIDIA had made a nice little rally. Discretionary started the day strong thanks to Tesla. It pulled back by the end of the day, underperforming energy and industrials. Communication services, again, that's where a lot of NVIDIA has got a lot of the AI in it, Broadcom as well, but Google and Meta, that's really the only thing driving Google and Meta right now is the hopes of AI impacting their bottom lines. And so that's really been lagging behind. Utilities down sharply again. Again, that doesn't happen. Utilities underperform if yields are falling and expected to continue to fall. So, weakness in utilities might be an idea that, yields are actually going to be rising here, not falling. And so this little pullback we've had in yields might be very temporary. Otherwise, we might see a lot more buying in utilities to take advantage of the 10-year yield, especially potentially crossing back below that key 4% level. All right, so that brings us to our trade idea of the day, and I want to take advantage of this potential rally. We've got plenty of bearish trades, especially in our class portfolio with the examples that we do in our trading rooms at marketscholars.com. So we've got plenty of bearish trades, but we've been adding a lot more bullish trades here recently with this low being established and kind of bouncing up. And so again, while I might not be fully on board with this idea that we're going to take off to 4,800 by the end of the year, if we do, I want to have something that will take advantage of that, and that's Apple. Apple getting the bear tag today, biggest stock, of course, in the S&P, back above 1.5%. So not the greatest move yet, but that's a pretty good move for a bear tag, right? Getting a bear tag, this bear tag we were only 0%. Above, so barely above zero when we got that bear tag, and some of these other bear tags, we got this one, we weren't very high until we got 2.82%, and then that led us higher. So we like to get bear tags when you've really made a good break above that 30-day and changed the direction, and that's kind of what we're getting here with that near-term line getting up to extreme levels. You can see the reversal pattern. This almost exactly looks like the S&P's chart. I got the reversal there with the green arrow. You got the 3 green arrows today on Apple for the first day today. Looking at its volume, you can see it was slightly above average, different from what the market was showing us. Looking at the 2-line version of Apple, you can see again MACD crossing above 0, stochastics in bullish territory already, crossing the 30, crossing above the 17 yesterday, the 30 and the 50 today, already above the value area. So really good reversal opportunity here that we can, again, if we get up. If we don't, you'll see it's a very small risk. But if we do, we can get a good reward for that very small risk. And that will kind of be like a proxy for just kind of buying the market in general in this particular trade, right? With this one particular active trade. If you take a look at the DMI, you can see that we got the crossover above 30 on the positive. We're not quite below 20 yet, but the ADX is high, so we can get some good movement. We don't have to wait for the ADX to turn all the way up above 20. We're already in range where the moves are going to be bigger as it is. It's crossed above its blue line on the Ichimoku cloud. It's gotten into the cloud as well. The bearish trend we had is also gone, just like it was for the S&P. You are almost above 60, really close to getting above 60 on the RSI. You did get above 200 on the CCI, so good opportunity for a change in trend there as well. And then you can see we are in the 87th percentile, so a little bit stronger on the Bollinger Bands, and actually pretty darn close to breaking above the Keltner channel already. So really good move, big significant change in bearish sentiment here, bearish momentum, excuse me, potentially to new bullish momentum. So I like the trade for a bullish setup. So we're going to come over here and take a look at its options chain. We're going to buy not the 1 strike away. So here's the at the money. Buy 1 strike away. We're going to go down and buy that kind of mid-30s delta, and then sell 1 strike away. As long as it's not too far below 20th percentile, that ends up giving us or 20th delta, excuse me. That ends up giving us about a 3-to-1 reward to risk ratio, pretty close to a 3-to-1. So if we do make our way up to 200 or higher on Apple, we get a good reward. If the S&P makes it back up to towards 4,800, great. Apple will take advantage, and we'll take advantage. If it doesn't, then we'll have a at worst a $500 loss, but more than likely around 100 or 200, 250. So, and at $250. We're getting, almost a 6-to-1 reward to risk ratio in that case. So I like the setup here. I like the proxy, using this as a proxy for what we anticipate the broader market to do as a whole. Again, this is just one example. We've done others in our classes online here. Yesterday I do an options class, and we did plenty of examples there, and I put some more on this morning that I sent out via Telegram to our students. Just some more examples of trades we can take advantage of a bullish market with, knowing that we're just fine if this does turn out to be a fake out, which is actually the camp I lean towards, that this ultimately may be one of those bear tag bounces down to the downside and not the reversal. But if it is, and it always, it is a reversal more often than not, then this trade among others is one way we can take advantage of it with limited risk in case it's not. All right, well, that wraps us up for today. You've heard from me. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forums. Open up any new thread there with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on the video. Join us at marketscholars.com for free. Follow and like us on Twitter and Facebook as well. Have a great rest of your Wednesday night, everybody, and we'll see you all next time.